Hello, everyone, and welcome to Calling All Real Estate Investors, a live event with Caeli Ridge from Ridge Lending Group. You can reach us at info@ridgelendinggroup.com by email, or you can always call into the office at 855-747-4343. That's 855-74-RIDGE. During today's live call, if you have any questions throughout, please just drop those questions into the chat as they come up, and then we will answer them as soon as possible. And today we have a very special guest speaker here with us, Sam Parker from My Credit Guy. I'll hand the mic over to Caeli now for his introduction and to get into today's episode.
Thank you, Mrs. Smith. Hey, gang. Nice to see you all. For anybody that I didn't see last time, Happy New Year. I feel like I can use that through the end of January. It's still valid. And for anybody that missed us last week, my sincere apologies. It was a complete shit show. The weather down here in Portland was nuts. It was absolute disaster. Across the board, the whole city was shut down. So my apologies for anybody that tried to show up, didn't get the notification that we had to postpone. And to you, Sam, I haven't even talked to you since then. So my apologies to you for that last minute snafu. Anyway, thanks for being here. I'm happy to be with you. I think today is going to be an excellent bit of content. I'm very, very excited. I've spent some time with Sam. I find him to be extremely knowledgeable and extremely credible. I know that you guys are going to feel the same way. Before we get started and before I officially introduce Mr. Parker, something came across my desk. It's been something that's been peeking in here and there, and I think a lot of us in real estate investing have probably started to read the headlines or see some of the publications. But I wanted to just take a second and touch on it before we get started today, and that is commercial real estate is struggling. And by struggling, it is on its way down in a big, big way. And before I give you any of my personal opinions or predictions, which I was looking back, and I think I'm about 70% in accuracy for some of my predictions in real estate and interest rates and what the forecast for things are. So not super great. I don't know that you would take me to Vegas, but I don't know, 70% might be good odds. I don't know. But I do have a good, strong indication about this. So for anybody that is interested in commercial real estate or maybe thinks there's some interest futuristically into some commercial real estate, I think that you should start paying a lot closer attention. Here's what I'm going to say for the record for now. We're going to be in a very unique position. And I should preface by saying I've never gotten into personally anything over like 5-10 units in real estate. And that's not what this is. I'm talking about retail space, office space, like the big boys. That's going to be on fire sales soon. And for anybody that wants to be at the ground level where real estate, because it still is real estate, where real estate is concerned, you should be paying attention. I was talking to another client recently about this, and she agreed that there's going to be some unique opportunities. So here's what I would share. You talk about some of the things that I've been noticing most recently, they're office conversions. Now, I will preface by saying that currently financing for this type of property, this class type, is not going to be as easy as just picking up the phone and calling Ridge. We do some of this stuff, but it's a different animal. So you're going to want to do your due diligence there. But when we talk about office space or office conversions, I think a lot of people are going to be looking at that and preparing for taking advantage of very, very low priced inventory to turn into hospitality, perhaps, housing, perhaps, on those bigger office type scaled properties. The other ones that I think are going to do very well, the retail spaces for things that really need in-person attention, the spa, health, wellness, that kind of stuff. There's lots of different mediums and venues that are going to still need commercial real estate. So now is going to be the time, if you guys do want to take advantage of, I would start educating yourself about what's going to be coming available in your backyard or what markets we think are going to be hit the hardest, and start investigating there. And you may even be a little bit late to the game if you start now. Not for the masses, but for the people that understand commercial real estate especially. They've already been putting their fingers all over this thing, and they're going to be ready to make a mint. commercial real estate can be highly lucrative if you get in on the ground level. And that's, I think, coming up real quickly here. So I would just encourage you. That was really it. I just wanted that sound bite out there. I would just really encourage you guys to start looking into that and taking note of commercial real estate as a means of real estate investing. And feel free to call me or email me if you guys want to talk further about any of your ideas or things that might have to do with that. Is that it? I think that's all I wanted to mention. Oh, you know what? There was another thing that I just recently talked about that I wanted to talk about real estate, commercial real estate. So airports, this might be something of interest to some of you, and it's similar to housing in that the micro unit hospitality hotels. So you've got a lot of, for years and years, you would see the pop-ups, those strip malls that weren't far from the airports that have, you know, the fast foods, and things of that nature. Those are all going away. They're just not doing well over there. So they're talking about micro unit hospitality for just overnight people that need to go. They want to be by the airport before they're traveling, for the flight attendants and the pilots, et cetera. They've got the, you know, the Sheratons and stuff, but these are going to be a little bit different on a smaller scale. But for those that just need those quick overnights and have key access codes and things where you can just go in, drop their stuff, sleep, and then leave, that kind of thing, that micro kind of strategy. So look at those possibilities as well. If you want to look that up, micro hospitality near airports, I think there's going to be some big wins there. Okay, enough about that. I will no, actually, let me start by saying, for any of you that have gone through my certified power buyer course with me one-on-one, related to the education that we do, you know, or have heard from me what I talk about credit-wise. We do some deep dives into definitions from underwriting guidelines, how it applies to credit and qualifying your credit, and how it applies to you and qualifying and what you qualify for. And then we take time to talk about optimization for future values, right? We're investors, so our credit scores are constantly going to be moving and changing and up and down, et cetera. So it's important that we understand from an underwriting perspective what that means and how to keep it at its best and its optimal. So we do get into quite a bit of that. I have not had conversations with anyone really that I can think of in the last 10 years that really understands it from that perspective as much as Mr. Parker does. So I'm really excited that he's here. I think that he's going to enhance everything that I talk about. He may even give us some new tricks and tips. So this is going to be a lot of Q&A, you guys. I've got some things that I'll ask him, but he's got his own spiel, and I've heard him give it a couple of times now, and I'm hoping that he'll do that again here today, because it'll be a lot more efficient than what I would be able to regurgitate. I know I'm going to forget things, and so it'll be a lot more complete and accurate if he gives it to us, and then we'll get into a Q&A. So when he's talking, think about your questions related to your past experiences or et cetera, optimization about credit. Write them down so you can put them in the chat for Carly to ask. And then let me just read his bio, and we're going to get Sam to give us what he can on credit. So he's got a world of experience. I think that if I remember correctly, Sam, you've been doing this for about 105 years. Just kidding. So 20 years of experience in the credit repair business. Sam has been a key player in bringing quality and integrity to such a fragmented industry. And just to kind of dovetail on that, you guys, credit is kind of a black box. Does anybody feel that way, where you kind of get an idea of what credit scoring is, where to find your credit score, how to keep it good? You get different answers and information. I mean, you could ask the question 10 times to 10 different people and get 10 different answers, right? So I think that it's really important to have somebody that has their finger on the pulse, that lives in that space as an authority, and getting the information directly from them. It's not a good Dear Google topic, I'll tell you that. Okay, carrying on with his bio. After working for other companies and recognizing where they were falling short, Sam set out and started his own business, My Credit Guy. Sam's vision for how to treat people right, which is another thing I loved about him, his personal touch to everything. What you say you're going to do and add more value than any other credit repair agency has been a key formula for My Credit Guy's success. It's more than just increasing credit scores. It's also about getting people educated, love it, and setting them up for success in the future. Sam is well known in the industry and is a go-to expert on all things credit repair. You will often see him speaking at leading industry events. That's huge. And or hosting webinars where he reaches people all over the country, focusing on important lessons on how to repair or rebuild poor credit. His passion for the industry is also seen by the guidance he provides mortgage and real estate professionals to help build their business and succeed. By focusing on technology-driven platforms, Sam has created a credit repair company that no others compare to. Sam's partner in business and life is his wife and co-founder, Trisha, and he couldn't get it done without her. It's so sweet that you put that in there. Sam, they share two beautiful daughters, and they mean the world to him. So welcome, Sam. Thank you so much for taking your time to be here with us today. Really appreciate it, my friend.
Of course. Thank you so much for having me again. I've enjoyed our conversations before. And so when you brought this up, it was something I wanted to hop all over. So thanks for having me.
My pleasure. Yeah. So what I was hoping, if you could, just kind of an overview of your services. Maybe abbreviate, because I really do want to give the people that are here today an opportunity to do some Q&A. I expect that there's going to be some good questions. So just kind of that soundbite or
Yeah.
30,000. Okay.
Yep, I can do the elevator pitch, right?
Okay. Yeah.
We got 20 floors right now. So
Okay.
basically what we do as a company is work side by side with our lender and real estate partners to help their clients by starting with a review of any and all credit reports that you have. If you have a client with a credit report, you can send that over to us. If you just have a client that has identified themselves as having credit issues, we can pull credit. But we start with a detailed interview and a free game planning session where we'll go through the credit report, figure out what the client disagrees with and why. Just because a client says that they disagree with it or really hate it doesn't mean that it doesn't legally hold up, right? And so that's something that we kind of need to sort through as to what the game plan is going to be. But we'll go through and identify the items that are actually problematic. We'll also shed light on some things that they might not see or know about when it comes to credit, because a lot of clients focus on the wrong thing when there's other things that could get them points right away. We'll go through and get items like that removed or updated if they're inaccurate, outdated, or duplicated. If they do remain, we have a debt resolution team that will call up those remaining creditors with the client or on behalf of the client, negotiate settlements, pay for deletions, and resolution so that underwriters can clear the way and like what they see on the credit report rather than just leaving those out there, where most credit repair companies just dispute over and over again, even if an item's not going to come off the credit report. Each client is assigned to a dedicated credit coach that handholds them through the entire process, educates them, answers questions, and keeps our partner or you up to date every step of the way. Credit repair is a black hole in general because communication is so horrible. We exceed at communication, regardless of industry. Once you work with us, we will also have conversations about our communication, our flow, our process, because we take great pride in it. And because we pair great people, great process, and a great system, then we can consistently bring people back to the closing table. We charge no upfront fees. We are the only credit repair company that I know that truly does not charge upfront fees. We don't charge anything until the 30th day after work has already been done. And then we charge every 30 days again after work has been done and the client agrees and wants to continue on another month. And again, keeping you posted every step of the way so that we bring you back, usually within anywhere from 2 to 5 months is kind of our sweet spot if a client needs full repair. However, 40% of the clients that you send over to us, I'm just going to be able to give you a game plan that you can execute on without us being involved. The client's opening something up, paying something down, increasing a limit, transferring revolving debt to installment debt, something like that, that doesn't need our assistance, but that we game plan for you at no cost. So there's no cost to you, there's no cost to the client until we've already provided services. We guarantee our work. Each client does go into the process knowing how long it's going to take, how much it's going to cost, as long as they follow our process.
Are you kidding me? Are you guys listening to this? Holy crap, that is amazing. Absolutely amazing. And I'll tell you guys, it's been a shortish time, but in the shortest time I've been working with Sam and his team, I can attest, unparalleled, the customer service, the communication, the tech, everything is A+, top notch. I could not recommend them more. A couple things just based on what you said, and the costs are so reasonable. You don't pay anything unless they're going to actually do the work. They give you the game plan. I mean, that speaks volumes to me, because you know what you're doing and you trust in your abilities and you can offer that extra. I think it's very cool. One of the things I wanted to ask you is, this is not just for someone that has poor credit, especially for our clients. As you know, real estate investors, because they are constantly buying or selling or refinancing, they really want to keep that credit score optimal, for not just qualifying, right? Because there are going to be benchmarks in some of the products that we have. You have to maintain such and such X credit score, but also for our interest rates. Everybody in no matter how much I beat against the stream, everybody wants to talk about interest rate, and not everybody, most people want to talk about interest rate, and credit scores are directly linked to that. So even if an individual does not have damaged or poor credit, there is ways in which they can work with you and your team to look for that that schematic from you and your assistants to help them keep it at their highest level based on what they're going to do. And I have a scenario. Sam, do you mind if I just kind of give you the advice that I give, and then you can tell me what's right, wrong, or what could be better about it?
Sure.
Okay. So one of the things that I will coach with my clients about credit optimization, and something called rapid acquisition, is when investors are purchasing multiple properties in a small-ish window of time, very high credit scores, even if just temporarily, can take a pretty big hit down below even that qualifying mark. So what I tell them is that because a credit report itself is valid for 120 days, so when we run our credit, we get to use that report for 4 months, 120 days. So what I have been strategizing with them over the years, and it seems to be working pretty well, is that as long as communication is good and we know what they've got coming, if we know that there's going to be a credit score requirement based on having X number of properties and we're right in that mark, okay, listen, we just closed on 2 transactions over here. We've got 2 more coming, and at which point this report is now going to expire and we're going to need a new one. I am telling them we want to run a second report before those first 2 hit and could potentially damage, buy us a new 120 days so that we can use that and get done when we need to get done within the time frame that we have to get it done in. Does that resonate? Does that make sense in terms of advice for credit optimization?
Yeah, absolutely. I mean, because as soon as those new installment debts hit, that's going to hit your new credit section of the scoring algorithm. It's also going to re-age some of your length of credit history. So that's a great strategy to use. And there's that. And then on the other side of that, and I won't dive too far into this too soon, but there's dates to know in terms of reporting with credit cards. There's dates to know in terms of reporting with auto payments and how it corresponds to like monthly payments being reported. But with debt load, absolutely, that's next level strategy that you're providing to do that. And it makes tons of sense. So
There's a lot of, yeah, there's a ton of strategy here that we don't really think about. You know, those of us that have, and I've worked hard. I've worked really hard to get a very fine credit score. And there's similar, I think, to interest rates, there's a psychology about credit score. And it's funny because I'll have, husbands and wives apply jointly, et cetera. There's always a competition piece going on there where he may have 2 points over her, and it's kind of fun to look at. So you may be able to give them advice on how they can edge the spouse or the partner. If there's one thing that you could impart to us, most important for optimal credit scoring, what would it be, Sam?
I think it's the power in credit use, because I think everybody knows keep your payments on time, and I can get into that, and I probably will, but it's the using your credit that people shy away from and they get scared of, and mostly what I'm talking about in that section is credit cards and knowing how to use them to not only, I mean, they're such a cool tool. I mean, you can take free vacations, increase your credit score, not part with your liquid cash, all in the same, strategy, as long as you time it right and are smart about it. And so I really love the power of credit cards, and it's where so many people kind of shy away from it. So keeping those credit cards at certain dates below 50%, below 30%, between 5 and 10%, knowing when to have those payments in so that you're getting that optimization on a monthly basis. Like, a lot of people will they'll have a due date of say like the 23rd through the 26th, right? So they'll pay that, or they'll even pay it early. Some people are out there saying, oh, I made 2 payments and that is what increases my credit score. Really what is increasing credit scores is when a payment is made before the new data is sent into Experian, Equifax, and TransUnion. That new data is usually collected and sent in before mid-month. And then our payments aren't due until the end of the month-ish, right? And so every time that our credit cards are reporting data, if you don't have it paid off in time, they're reporting your high balances that you're paying. So even though you think you're playing the game correctly, you're not playing it in time to really have it affect your credit. So anyway, that's just one of those rabbit holes. It's just one section of credit, but it's 30% of your credit score that you completely control. There's no ifs, ands, or buts. It's just how you use your credit card. So that's my
Ooh, that's a good one. That's a really good one. I've got a ton of questions, but I think that I should defer to our audience here. What do you guys have? Anything for Sam that you want to ask, or were, curious about credit-wise optimization? How do you do this? How do you fix that?
And just a reminder, just pop the questions in the chat and I'll read them out loud. And then, if we need some clarification from you guys, we can unmute you and you can go ahead and give us that clarification. But any questions, just write in the chat.
Thanks, Carly. Okay, so as we're waiting for those, I guess I'll keep asking mine. So utilization, I think, and when the payments are made was the number one thing. That's 30%. Could you maybe break it down like a college grade? What are the percentage of different factors that make up the actual credit score?
Yeah, so as of right now, it's 35% payment history, which is just, do you pay your bills on time? Do you have late pays? Collections, charge off, profit and loss all factor into that, because it's just, did you pay your bill? And if you let it go, how far did you let it go? That's like the question being answered in that 35%. So while we're there, let's also talk really quickly on how to optimize, if you're cool with that. And that would be to get on everything on bill pay. It is so simple in 2024. You just bite the bullet and you go into each one of your credit cards, each one of your auto loans, and you hook them up to your bank account, and you won't miss a payment. And if you just want to add insurance to that, you get credit monitoring, and you just check it once a month, and you sign up for notifications on late pays or past due amounts. You can do that in them. And so with that, there's just no way to mess up. So late pays are the number one culprit there. But again, collections, charge off, profit and loss all fall into that category of 35% payment history. 30% is your credit usage, and that's the credit cards that we just talked about. You gotta get out there and play the game. Some people say, I have my credit under control, I don't use it. It's like, then you don't have it under control. That's not showing that you can use it responsibly and strategically. That's not playing the game, right? And you are costing yourself. I mean, I don't want to get too much up on a pulpit, but I would say if you don't have your credit optimized, you're costing yourself hundreds of thousands of dollars, if not millions of dollars in this game on lost opportunities as well, right? So managing your credit cards, knowing how to do that. Again, you can do a lot of that in your back office. You can set those payments to be made. You can say anytime that my balance goes over $2,000, I want it paid down by this amount. There's a lot that you can do there. 15% is going to be your length of credit history. And that's why when like a Dave Ramsey tells everybody close all your credit cards down, it's such bad credit, at least just credit. I won't talk about the rest of the good advice, but credit wise, it's horrible because it's eliminating those years of payment history. The same thing ultimately happens too. Like if you've ever seen one of your clients or you've had where it's a happy day, I paid off my mortgage, I paid off my student loan, I paid off my car, and then a month later my score dropped 30 points. What the heck? It's because your length of credit history, that was more than likely a 5-year account, a 10-year account that just got paid off compared to the rest of the accounts that have maybe been open 2 or 3 years. So when we close account, even for whatever reason, it removes itself from that average. Okay, so we want to keep accounts open for as long as possible and just be strategic with them. And again, that's why if we're in process or our clients are in process, please don't close a car. Please don't call me with the great news that you think you're being financially amazing, that you paid this off or closed this out, right? 10% is going to be mix of credit, and that is having both installment, like credit or student loans, car loans, and real estate mortgages, and a mix with revolving credit cards, lines of credit. There's two different behaviors there that the investors want to see. Installment is kind of set it and forget it. Think about that process. You sat down, you filled out paperwork that mitigated their losses pre-contract or pre-money being given, right? A credit card, they're just going, let's see what this guy does, you know? And so it's two different behaviors that they want to look at, and ultimately they're creating a credit score that's going to determine, should we lend this person hundreds of thousands of dollars or millions of dollars for real estate? That's where it all kind of crescendos, okay? And then the last 10% is new credit, which is like, are you getting your credit pulled all over the place? And then it's just, and you can't get away from this, but if you have a lot of new items in comparison to not that many older items, that'll kind of ding you for a little while until 6 to 12 months of pay history. So that's the breakdown: 35, 30, 15, 10, and 10.
Sweet, dude. That's such valuable information. Okay, we've got questions, but I have some of my own, so I get to go first. It's my show. Okay. Is a reasonable hack, so utilization, we talked about revolving credit card debt, and over 50% really starts to hit you, 50 below, 30 below, 5, 10, et cetera, is optimal. One of the things that I'll do, instead of having people throw a bunch of money at that credit card debt, is if they have that long history with the creditor and they've got a perfect payment history, go to them and say, hey, Chase, up my credit limit. I'm going to trick the system or manipulate the system so that now my utilization, as long as they're not charging anything more, utilization appears to their advantage, right? That's a good hack.
Yeah, I mean, absolutely. And you're not even, all you're doing is being rewarded for the good credit that you've built up. You just haven't cashed in on it lately, because if your credit wasn't good enough and your payment history wasn't good enough, they're going to go, no, you can't have a credit line increase, right? But I could go right now, and any of you could too. Log into your Citi card, log into your Capital One card. You can request a credit line increase right there. It's going to go, cool, how much do you make right now? You're going to put in your updated income in, you're going to hit it. It's going to run a soft pull on you behind the scenes, so a credit pull is not going to show up. It's going to look at your income, and then it's going to say, yeah, you can have that. Or it's going to say, no, we need to make a decision behind the scenes, or it's going to go, no, you can't right now, sorry.
Wait. What about authorized user? Now, this one is kind of a twofer on your side, and then on what we do for credit scoring. We see that a lot, authorized users. You know, in some cases, it can be detrimental to debt to income ratio, but what is your take on authorized user? I guess it just depends on the overall credit profile.
Yeah, I think that they're an excellent tool to use. And honestly, if there is a loophole left for clients, it's authorized user. The reason being that you're not truly legally liable for that debt. It's not like a joint user. So let's talk through it from the very beginning. Let's say that you don't have an authorized user account. What you're looking for is a spouse, business partner, or immediate family member. And the reason I say that is that there's shady companies out there that will try to sell you or your clients a spot on an authorized user credit card. Stay away, crazy, fraudulent. You don't want to mess with that stuff. But if you are in some way associated with the credit card and you're added as an authorized user, you now all of a sudden on your credit history, you're going to see all that person's payment history that's on there, and you're getting credit for it, full credit for it, like you were there for the whole ride, okay? Now, it could be a good ride or it could be a bad ride. If they've had a long payment history and they've been responsible with it, your scores are going to shoot up in most cases, like significantly, depending on what you started with credit profile and credit score. But we can see a really big increase, especially if somebody has thin credit. Now, if that credit card is late ever, maxed out, really anything negative, you're also going to experience that. So whatever it is, you're going to get, right? Now, here's the really cool thing about it. And we don't shout this out loud because we want this thing to stick around for a long time. If anything ever goes bad with an authorized user, you call them up and you go, I want off that thing. Get me off it right now. Take it off my credit. And they'll go, oh, well, it looks like on, I don't care what you say. I do not want this on my credit report anymore. Take it off. And they have to within 30 days. So it's a nice little hack that can get clients some points, especially in the case where they are associated with that credit card already. They should be added. But here's the thing, you got to make sure that you are giving, if you're the person adding that client or relative or friend as an authorized user, they got to have their social, they got to have their date of birth. Otherwise, they're just going to add them on as like a joint user or not an author, but they can use your credit card, but it's not like a full, it's not on their credit report. So you got to make sure it's a true authorized user. They'll read you a little script that's like, you understand that by adding this person, it is going to report on their credit report. And you're like, yep, cool, that's exactly the one I want. So all good on authorized users. And if they're ever an issue, we just call them up and talk tough.
Yeah. And that just kind of for let's say that we've got husband and wife teams or partner teams or whatever, and the one's got really strong credit, maybe the other one doesn't have any established credit. One of the things that we'll have them do for qualifying purposes is to start planting those seeds and get them on as authorized users immediately so they can start building that credit. Anything else for spouse or partners that don't have a lot of credit, Sam, that you would say they should do?
Yeah, I mean, so again, all strategy and it's all situational because a lot of times I like to separate debt, right? Like if I don't need to be on the line, then
Right.
it'll just be Trish or the other way around, right? But in a situation where it's like, man, we got to get her credit built, I would be adding her on to like car loans with me. If I was going to get anything new, I would be adding her on to really anything new that I was getting to get her up and off the ground. And then as soon as possible, we want to separate and be two very strong individuals with separate credit profiles as much as possible.
So guys, I want to make a point on that because it's really, really important for the lending side. Debt obligation is a pretty big deal. So if you need it for credit scoring, like he said, just to get them started, let's do that. But then ideally, you really want to keep that separate for DTI purposes because that debt obligation can be pretty a fine line once you start amassing investment properties and some of that debt plus the income. But if you've got a partner or a spouse that you want to use their golden tickets for themselves, start there, but then make sure that you are separating that debt obligation. You don't want to be tied to or have them tied to things that were really yours to begin with. Get them their own or none, ideally. Okay, one more and then yeah.
Right. On that point, credit is all scaled, meaning it is set up right now for somebody, regardless of your background or how much money you start with, to have the opportunity to have a high credit score. And that's one thing I love about it. It's like the American dream put into like an algorithm. Just work hard, do the right thing, and regardless of where you come from, you too could have the opportunity at an 850 credit score, right? And so the reason I'm saying that is if somebody's just getting started, they can get started with a $200 credit card. They can get started with a $500 credit card. They can get started with a $5,000 auto loan. You might have $20,000 in the bank right now, probably more, I know, but your kid might even, right, to go buy that car. I would suggest financing it. And people are like, pay interest on it? It's like, no, get a high credit score, pay lower interest on your $400,000 first home that you're going to buy and pay a little bit more on a $5,000 car right now. So there's just, again, some strategy there. Sometimes people are like, I'm not taking on debt if I don't have to. And it's like, you're going to take on debt sooner or later. It's building to that, again, that peak, that crescendo where you've got to have awesome credit to borrow hundreds of thousands so that then you can cash out on hundreds of thousands, down the road. You guys know what I'm talking about.
Yeah, that plays into, I'm always preaching about doing the math. You got to do the math in order to understand where it is you want to go and what you're about to accomplish or not accomplish or the risk that you're taking or not taking. You've got to be doing the math. Absolutely. Okay. My last question, I swear, before I forget, I wrote this down. The best monitoring service, do you have a recommendation? What's the best one?
I do. So as a separate company, we were tired of seeing people not have access to FICO. So we built credtsitter.com. So that is ready now. It's a FICO only option right now. We do have a relationship with Vantage. So soon it should be that true marketplace where the client can choose from the two. Ours, though, at Credit Sitter, and I do have to be clear on this, ours meaning mine and Trisha's in partnership with Experian, the credit bureau. It's not a product of my credit guy. They make sure I say that.
Okay.
But what it is for $32 a month, which is normally 45 to 60 on other FICO products, a client can monitor their FICO and update it twice a month, where right now a client in the marketplace can usually only update FICO every 45 days. And that just sucks when you're trying to increase credit because you're doing actions. You don't want to wait a month and a half. So creditshitter.com is ours. There are some others out there. Identity IQ, I like for Vantage. And then if nothing else, and I hate them, but Credit Karma is better than nothing. I would still rather have a client cognizant and watching their credit than not. It's just that what people do have to understand, and this is bleeding over into another topic of trigger leads. People will be like, oh, you pulled my credit for an investment property and now I got, 42 calls because of you. It's like, no. I didn't like submit your information. You, when you chose free things like Credit Karma, logged all your updated information with them, and then they sold it when we pulled credit. So again, just be cognizant that if I always tell people, if you don't pay for the product, you are the product, right? And so Credit Karma is that, but I'd still rather have them aware of credit and getting notifications. But creditshitter.com is the best.
Sweet. Carly, will you put that in the chat, please? Creditshitter.com. I'm checking that out. Thank you, Sam. Okay, you can read questions now. I'll give him up. You guys are open for Q&A.
Perfect. All right, we're going to start with Lorena. Thank you for your question. She said, thanks for coming, by the way. And she said, we use our credit cards to support our real estate. They do flips into rentals. So
very successfully.
Yeah, her credit scores fluctuate quite a bit depending on whether she's having them charged up or paid down. But even though she has nothing negative and no late pays, her score is impacted when she uses the cards. Yep. Should she open up a line of credit or do something else?
Great question. And trust me, I get this. I have my city cards with my airline miles and I rack them up as much as I possibly can. And that's just smart. You run everything you can through them. You got a couple options. What I do is I sit right on the back side of those. Anything that's a large or a certain amount, I pay off right away. So I run it through the card, I let it count for my airline points or whatever, and then I'm paying it off usually within a day or two. So I'm not having those issues of fluctuation. The other thing is just to know yourself for the most part, meaning, am I going to make any major purchases? Not in the next 30 to 60 days. All right, don't stress about it too much. Just use your credit cards as you would, right? Otherwise, you just have to, again, be cognizant of what you're trying to do and go, this month, I'm going to have to keep them in this range, right? Rather than letting them go up and down, or just make sure you're making that payment. So all I'm trying to say is be situationally aware of what you're trying to do. We could say the technically correct thing, always keep them there. But once we get to a certain level, everybody, where it's like, I get credit, I'm not struggling with the concepts of credit, I totally understand it, then you get, I say, look, you can max out credit cards, you just got to know when you're going to finance, you got to pay it down. Now, I will say this, and then I'll end my tangent, sorry, is that with the updates coming, okay, so you have the new FICO coming out, and you have Vantage that are supposed to be released within the next 2 years. They are going to have what is called trended data built in, which means the ability of running a high credit limit and then paying it down really quick is not going to be there, because they're going to trend and that data over the last 24 months. And so they're going to look at your average over the last 24, not what is it today. So the days of paying something down, rapid restoring it, and then boom, you're an 850 or 820. That's probably going to be a lot tougher to do going forward. But again, if you want to get way ahead of that, then just use that strategy of, oh my gosh, we just paid off the whatever, that's a $12,000 charge. Jump on and pay 11,000 off, in 2 days. If that's what you're doing, is kind of playing that credit card game.
Perfect. Thank you. And Lorena asked, when is that coming online? And I think you said maybe in the next 2 years is when they're doing that.
They keep pushing it back. And here's what I'll say is that, like, a lot of credit updates get a lot of hype. It takes the burden off of the credit bureaus from like a social perspective, because everybody's like, oh, credit's not fair and And so they're like, no problem, we have this update and it's coming soon. Everybody calms down, and then they go back and they go, hey, banks, what do you guys want? That's what we'll use, right? And so we'll see. They have pushed into late 2025 right now, which sounds a whole lot like 2026 to me.
Perfect. Thank you. Lorena did add a little thing here that her cards are sitting charged up until we refi. So does that change anything from what you said at all, Sam?
Well, it's just that if you have a refi coming up and you're
I
trying to
got that one.
for it,
Nice.
I would like to see you move that. Now, you got two choices, okay? You have, if what you're doing is out of that refi gonna pay these down and you're trying to kind of move that debt to increase credit, you can move it two places. You can move it to installment or you can move it to revolving. If you move it to installment, here's what you're gonna get, okay? That new installment, if it hits, you might be looking at like 20, 30 points, right? But you're probably getting a lot of points from paying down credit cards and getting rid of that revolving debt. Don't close the credit cards out, just pay them down. If you're moving to a larger revolving line, you got to move fast. So kind of like what we were talking about earlier about how, hey, I have this coming up, I'm going to pull credit and then it's going to last this long. If you're moving revolving debt to revolving debt, you have a window where when it's paid off, that new one has not shown up on credit, usually for 60 days. You need to move fast right there. Have credit pulled, you're still going to have to account for the debt on the DTI, but credit score wise, you're going to be in a nice little sweet spot right there.
And let me add to that too. So Lorena, in that case, and they've been wildly successful. She and her husband have really mastered the art of utilizing their credit to their advantage and leveraging what they've done is pretty remarkable. But that kind of plays into if the timing works out with what the renovation or the fix flip trajectory is, that 4 months of utilization of the score, we can strategize and time it so that we're pulling before you're actually driving those cards, those limits up, the usage up, and we have that for 4 months. So if it works within the project, if it's a long project, then maybe not so much, but there is a piece in there we can strategize timing wise. Anyway, sorry, Carly, go ahead, honey.
No worries. Thank you. And thanks everyone for your questions. We have a new one here from Teresa. She asks, I had my credit pulled in November for a mortgage. I have a good credit score. Another lender wants to pull my credit again. How much will my credit score decrease because I'm out the 2-week window after having 4 lenders pull my credit?
So I want to just real quickly, because I want Sam to see if I'm right or wrong on this. There's every time I have this conversation about inquiries and how it affects the credit score, et cetera, I hear everything from you've got 1 week to have it pulled as many times, you've got a month, you've got 2 months, and it's going to drop 20 points or 5 points or 50 points or whatever. I feel like it's 45 days. I believe the CFPB publishes this. I'll go over that in a second. We can put a link in the chat. And that they should be able to have it pulled as many times as they need to for exclusively, I'm trying to be smart here. I know I'm going to be wrong somewhere, for exclusively mortgage related purposes, not for cars and boats and flat screen TVs and new credit cards. Exclusively for mortgage related, they're supposed to have that window, right, Sam, to have it pulled as many times as they need to without an adverse effect on the score. Is that right?
Yes, so you are right. 45 days, no additional adverse effect. The first card inquiry can cost typically anywhere from 2 to 5 points, but it is not that doppelganger, what am I trying to say? That's not what I mean at all.
I know what you mean.
That's not that monster that is going to cost you 20 to 40 points. It's 2 to 3, maybe 5, a lot of times 0 points. And then a 45-day window to shop as a consumer as much as you need to. Now, I do tell consumers, do a little research first, please, because going out and having your credit pulled everywhere is not the best thing. But at the same time, you got to make sure that you are doing what's best for you and your family, and you have the right to do that in the same industry. You're absolutely right. Now, if you go out and I went and I applied for a mortgage, a credit card, a car loan, a line of credit, all that, those are all separate industries that could all cost me, again, 2 to 5 points, but it is not the credit killer that people make it out to be.
And when they see their credit drop like that and they think it's because of an inquiry, guys, credit scores, and this is another one, Sam, check me if I'm wrong in any space here. Credit scores it's similar in some ways to interest rates in that they can change daily based on a variety of variables, which might be the utilization. It might be a multitude of inquiries. It might be old and new and lates and things that it could be all of these things, right? That
yeah,
they may be thinking is this, but it's all that.
It's the constant scapegoat. It's what do I not have any control over? Inquiries must not be. And And that's where I'm like, hey, hold on. It's probably the fact that you let your credit card see your city card. It jumped up from 29 to 32%. There's the 12 points that you're missing. Well, what about these inquiries? 2 points. It's still just the 2 points. Like, I know you don't like my answer, but it really is a simple one. But it's just go on there and pay $4 and you're going to drop back down and you're going to be good. But it's almost always when I see somebody that says my credit score went down in the last month, it's late pays, it's a collection hitting, it's increased credit cards, it's a closed account. Almost always one of those. There's a few other outliers that might hit in that meantime, but those make up 90% of what happens. And then every once in a while you have the big ones come on, you know, a charge off or a collection or something like that. But it's usually something simple that it's like not an inquiry.
Okay, thank you, Sam. What else we got, Carly?
All right, perfect. Peter asks, how early can you add kids onto car loans and other recurring payments to help boost their credit score and their credit profile, you know, before they hit college age, 18 or 19? Can you do it earlier?
You can. A lot of times, like a local bank, you can do it as young as 17, I believe. I like to wait, and that's state by state too, in terms of lending guidelines, I believe. Well, I know, but 18 at least. It's like get going. If you're gonna, especially if you're gonna buy your kid a car and not pay cash for it, have them on as a joint user and teach them what it is to build credit. Now, while I'm on this, I really want to talk, and I can talk fast about what am I trying to say? Co-signing, sorry. So if you co-sign for somebody and you're gonna do that, and I don't suggest doing it, but if you're going to, make sure you're the primary on the account, not the co-signer, because it doesn't matter. You're 100% legally obligated to it no matter what, whether you're the co-signer or the primary. It's just that if you're the primary, they're gonna call you when a payment's missed. They're gonna email you and text you when a payment's missed. Where if you're the co-borrower, you're gonna hear about it once your credit score drops by 70 points and you have a late pay that you can't remove off the credit report.
Boom.
That's good.
That was worth the price of admission. Yeah, good one. What else we got, Carly? Anything
All right,
else?
we got one more here from Dr. Haywood, maybe Dr. Haywood, but can you clarify, is the 30% credit usage for your current credit card debt to credit limit ratio, assuming it's paid off monthly?
%. Okay, so sorry, because there's percentages and then more percentages. So 30% of like the pie graph, okay, is credit usage. And that is basically the credit card section because that's what they're looking at. When the scoring algorithm looks at installment loans, it's already pre-calculating in the risk, right? And so think about all installment loans. I bought a $450,000 house. I was able to use a 0% program on that 450,000, or I maybe put 3.5, 10%, you know, stuff like that. So the scoring algorithm doesn't ding you for high balance to limit ratios on installment. It's on the credit cards. And then once you get into the credit cards, then it's, you want to keep them below 30% ideal, or in a good world, and then between 5 and 10%. But know that if you cross the 50% threshold on a revolving account, you have entered into that account potentially hurting you more than it's even helping.
Yeah. So 50 and below, good. 30 and below, great. 5, 10 is bling bling.
Yep, and 0% can be problematic. And that's because if you put it in your wallet or your purse and you don't take it out for months, you're going to stop getting credit for it too. You need to display responsible behavior where they are incentivized to keep doing business with you. And that is letting them make a little bit of money too, or have the potential to.
Yeah. Carly, I like that last. I'm looking at the questions now. I think that's a great one. Let's finish with Mr. Peter and his question, can we?
Perfect. All right, from Peter. First of all, he says, thank you for this live, great info. Thank you, Peter. Is it possible to have late payments removed from your credit profile? I've heard mixed information on this. Some have said goodwill letters can do that.
Yeah, great question, Peter. And it sounds like you're already on the right track and pretty knowledgeable about this. Goodwill letters is where I start. And yes, you can have late payments removed, but when credit repair companies make a broad statement, like we remove late pays, it's like, you're just misadvertising, because it has to be situational. If someone has a long track record of late pays and then they miss another one, we're going to have almost no shot at getting a goodwill letter to work, because it wasn't a one-time isolated incident. If there is a long relationship, if there are extenuating circumstances, excellent chance at getting a goodwill deletion. If it's in the middle of you kind of not paying a lot of things or not paying that account many times, almost no chance. Okay. Now, if a goodwill negotiation does not work, we can follow up with a true dispute, and we do get items like that removed, but you're talking single digits, under 10% of the time are we going to be able to move a valid late pay if it doesn't get removed through a goodwill, which is probably actually about 25-30% success rate when we're going at it right now.
So awesome. I just, in the sake of time, Lorena, my friend, I'm gonna copy that Carly, will you copy that question for her and send it to Sam and his team, and maybe we can get an answer for her off book. You have been amazing. These are I love it when they go over, because that means that we're really digging into it and some good content is getting out there for people. So thank you again for your time. Carly, will you maybe wrap us up? Is there something that we need to know about the next podcast? And of course, all of Mr. Parker's contact information. Will you get us done? Take us home?
Yeah, absolutely. So for February, we're going to be having our lives on February 6th and the 20th. You'll see that email come over with those topics shortly. February 6th, Caeli's going to talk about doing the math. One of her, best
My
topic,
slogan.
her slogan,
Slogan taglines.
exactly. So keep an eye out for that. And then I'll actually hand it over to Sam. I want to make sure that we're getting that information out correctly. Sam, please let us know your website, contact information, where people can find you.
Yeah, absolutely. So you can go to mycreditguy.com. I am going to pop a link right down here, if that's okay. And this is to get marketing information, sign up for a one-on-one demo, have us set you up with a tracking portal, all that good stuff. In there, you'll see that we've taken a lot of your social media or marketing off of your plate. We can customize so much for you. We just want to educate. You'll see none of it's marketing, it's all education, and that's what we want to help you do for your clients. So mycreditguy.com, or reach out to us through the team-parker.com, and we can answer any questions for you, run through any scenarios, or give any support. But thank you so much for having me on. I really do appreciate it, and great group and great questions.
Appreciate you, Sam. Just FYI, these are going to be the clients. So guys, you working directly with us, we will link you with Sam and his team as well if you want to go that way. But if you need direct access, it's all right there in the chat.
And we should, just to make that process clear, as many as we can, we should run through that, just because we have such a sweet process ready for you guys to run it like that. But yeah,
through us and then to him.
Let us know.
Yeah. Cool. So again, just to clarify, guys, working through us, and then they've got, the tech is amazing. We will then submit who you are and your information. You go directly. There is no compensation. We're not making anything. There is no JV, nothing. This is just all for education, like Sam said. Okay, any last words, Mr. Parker?
No, just thank you. We're ready to go to work for you.
Okay, appreciate you. Thanks, guys. We'll see you soon. Bye, gang.